I think there is some degree of acceptance now that business travel may not recover to the same levels as 2019.
There will be a broad, comprehensive approach to pandemic preparedness and response at every level.
The key to NYC Pass will be a first-in-the-nation approach. It will require vaccination for workers and customers in indoor dining, in indoor fitness facilities, indoor entertainment facilities.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on the day's program. Commerce Bank sticks to its revenue target despite earnings missing estimates. The lender's CFO tells us that they're making good progress on the restructuring plan. China sees its broadest COVID outbreak since the beginning of the pandemic. Analysts downgrade the GDP outlook for the world's second largest economy. And the ECB won't rush to signal the future of its bond buying program. A governing council member tells us that investors may be in for a disappointment if they expect a heads up in September. Well, good morning, everybody. We are seeing a bond market whose gravitational force is towards lower yields, especially in Germany after those headlines out of the ECB. You have an entirety of a bond curve that's now below zero, and you had Japanese 10-year yields dropping at 1 point below zero for the first time since September. A little bit weaker in your U.S. American equity futures session, but in Europe, it is all about the record highs. It is about the earnings season as it continues to roll on. So let's get into that. European stocks at a record high as more than 50% of European companies have now reported earnings for the second quarter. But this morning has seen mixed results. We had big winners like UK home builder Taylor Wimpey to under pressure German lender Commerce Bank. Let's break down the equities now with our equity editor, Joe Easton. All right, so Joe, again, another busy morning. How would you kind of characterize the state of earnings so far of what we've seen from companies this morning?
Yeah, so as you mentioned, we've seen these big beats against analyst expectations, which kind of is positive, but it only goes so far, and seeing we know analysts tend to eventually bring expectations down in line with the economy. So we did see that during the big recession. Now we're beating those estimates. But importantly, what we're seeing is the margins are really strong mainly. So the margins are being not only beating expectations, but maintaining pretty strong nominal margins against where we were pre-pandemic. And that means the big inflation concerns, the cost rising, the shipping rates, all that stuff can be absorbed. And we're seeing that generally across most markets now. And also just on valuations, you know, although we are at those record highs that you mentioned, some sectors still do trade below pre-pandemic levels, like airlines, travel, even banks. So there is still room to go potentially.
Yeah, and of course, you know, those high margins are remarkable in a time when you have those inflationary concerns. Okay, you mentioned banks, so I want to go there. We had Commerce Bank this morning, share prices falling. I mean, are they just missing the mark and not stacking up against their peers? What's going on with Commerce Bank?
Well, so Commerce Bank has its own kind of issues that you did mention in the intro, with their own restructuring issues and that kind of thing. But in terms of what they're exposed to, they are exposed to the general themes that we've seen for banks this earnings season. That being fixed income really weak versus last year's boom, wealth management soft again, but companies are releasing these funds that they set aside for bad debts. We know that's better because the economic outlook has improved. And then on the retail side, we're seeing a rebound in credit card activity, but what we're not seeing is credit card balances coming back higher, and that's because people aren't going on holidays, which they usually put on credit cards. So then companies on the retail side aren't getting that big high interest retail income, and Commerce Bank is basically exposed to those broad trends.
Okay, so let's go from Germany to the UK. We had home builder Taylor Wimpey, a housing boom obviously helping them out, but is this peak? Is it going to get any better from here for them?
Yeah, so again, we go back to the margins. They're basically saying that housing prices are so strong because of this demand increase we saw in the UK, which was largely due to the stamp duty holiday. So house prices so strong that they're managing to stave off that kind of increase in raw material prices. The problem is that mortgage holiday has now come to an end, and there's worries that the demand then drops off. And that's why I think we saw Taylor Wimpey's shares quite weak into the earnings report, and now they've kind of rebounded founded on this margin news.
Okay, Joe, thank you so much. You're all over always all of the sectors. Such a pleasure to have you on to cover these earnings stories. That is our equities editor, Joe Easton, joining us. Thanks as always. Now, China's broadest COVID outbreak forces the government to cut travel. This prompts analysts to downgrade the nation's GDP outlook. We're going to discuss China and the future of the renminbi. Up next, this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get over the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Good morning, Danny. The British Navy says a ship is now safe after a possible hijacking in the Gulf of Oman near Iran. UK Maritime Trade Operations, which monitors commercial shipping routes, says boarders have left the vessel after its earlier reports of a potential hijack. Last week, a tanker was hit by a drone attack in roughly the same area, killing 2 crew members. Iran was blamed by the West. President Biden, along with other top Democrats, are calling on New York Governor Andrew Cuomo to resign after a state report found he sexually harassed multiple women and violated federal and state laws. State Attorney General Letitia James says Cuomo and his staff retaliated against at least one former employee for coming forward. Cuomo denies the accusations.
Are you now calling on him to resign?
Yes.
And if he doesn't resign, do you believe he should be impeached and removed from office?
Let's take one thing at a time here. I think he should resign.
More than 500 firefighters are reported to have worked through the night to contain a large forest blaze on the outskirts of Athens, forcing thousands to flee their homes. The fire was the worst of more than 80 that have broken out in the country over the past 24 hours. Greek officials say it's one of the worst heat waves of the past 40 years. Most kids who get COVID-19 recover within a week. That's the finding of a large UK study which followed 250,000 children. The researchers quoted in the Lancet Child and Adolescent Health said about 4.4% of children with symptomatic COVID experienced symptoms for longer than 4 weeks. Fatigue, headaches and loss of smell were most common. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Danny.
Laura, thanks so much. Now let's move to China, where the broadest COVID-19 outbreak since the beginning of the pandemic hampers tourism and spending. At least 46 cities have advised their residents to refrain from traveling. As risks escalate, analysts have been prompt to review their economic growth forecasts. One of them was Nomura. The Japanese bank has downgraded its GDP projections for the full year. It has cut its growth forecast from 8.2% to 8.9%. Now, joining us to discuss is our anchor, Tom McKenzie. Tom, of course, formerly based in Beijing. So, Tom, why is China, does it feel, moving backwards when it comes to the COVID situation?
Well, it's the spread of this virus, and it is largely the Delta variant as well that China is having to wrestle with. Prior to this, China had put in place a system that had really quite successfully controlled the spread of the virus. We've had a few clusters over the last 12 months, but they've been very quickly shut down. This one, though, has spread quite widely. You said 46 towns and cities have put restrictions on the movement of their people. It's now in more than half of China's 32 provinces. There are cases in Beijing and Shanghai. In Beijing, the restrictions have been very tight because, of course, it's the capital, it's where the government sits, and they've been very reluctant to see any virus there at all. So the fact that you've got cases there is significant. It is the Delta variant as well, and you've seen some breakthrough cases. The vaccination pace and rate in China has been quite successful, but it is, of course, using Sinopharm and Sinovac. The efficacy of those vaccines has been questioned. You talked about the fact that cultural sites, tourism sites have been impacted. Many have been closed down. Airlines as well have seen lots of cancellations of flights at an important time for travel and tourism in the country. So as you say, that's feeding into these question marks about the future pace of growth for the country.
Right. And of course, for a lot of these businesses, it's the unknown that is really painful. When can you reopen? When can you travel again? Is there any signaling or any sort of read across of when that lockdown could end?
There hasn't been any statement from officials that clarify how long these restrictions will be in place. We've never had that in the past, but you can look back at recent history in China and draw some conclusions, which is that they're not going to probably lift these restrictions until they feel very confident that they have a grip on this outbreak, particularly in those main cities of Beijing and Shanghai. It originated in a tourist hotspot, and you had a lot of tourists who were visiting, and they fanned out across the country. So it would seem unlikely that these restrictions are going to be lifted anytime soon.
And Tom, you mentioned the vaccines. What does it look like in China right now? What does the vaccination rate look like? Are they picking up the campaign, especially as Delta spreads throughout the country?
Yeah, it made a slow start, the vaccination scheme and process in China, but they really picked it up. You have quite a significant level of vaccination rates. It will now be accelerating even further on the back of this. Anyone who was reluctant will be coming out, you would have thought, and getting those jabs. But again, there have been question marks around the efficacy of both Sinovac and Sinopharm, which are the main vaccines that have been rolled out in China. The rates vary from 50 to 60% in terms of efficacy. In terms of the extent, the population, the numbers who have been double vaxxed, you're looking probably at around 60% or so. So China's up there with countries like the UK, the US and Israel. But again, the efficacy and the fact that there have been a number of breakthrough cases will be causing officials their concern.
Okay, so what does this all mean for the economy? How big of a hit will it likely take?
Well, you touched on Nomura. They have, as you rightly said, downgraded their forecast for full-year GDP. They had a forecast of 8.9%. They've cut that down to 8.2%. You've got Bloomberg Economics, NatWest as well, saying that there are headwinds to their forecast for growth. Goldman Sachs saying you could be seeing in the third quarter reduction in terms of growth for the third quarter GDP of about 0.7%. They have not downgraded Goldman their forecast. They'd say there's too much uncertainty, as you pointed to, around the restrictions, when they're going to be removed, and also, of course, crucially, that policy response.
Yeah, exactly. Let's get into that policy response, because there had been some noise around the triple R cut.
Yep.
How accommodative is the PBOC likely to be as these uncertainties continue to rear their head?
Well, there are now more economists looking for an additional triple R cut. There was a bit of a mixed view as to whether or not you were going to get another one that followed up prior to this, the spread of this Delta variant across the country. I would have thought now you're going to get more economists coming out and saying another triple R by the end of this year is now likely. The PBOC has said it's going to ensure that there's adequate liquidity, that it will continue to support the economy. And of course, on another range of data points, you can see that the recovery in China is starting to slow. You've seen that in the PMI data. You're seeing concerns about exports as well, investment in things like infrastructure and property. So you would expect that the PBOC will respond in some kind. You had the Politburo coming out as well recently saying they would continue to monitor the progress in the economy and make sure that there is support there.
Right. A lot of factors to dig through. Tom, thanks so much for joining us this morning. That's our Bloomberg's Tom McKenzie. Let's get more into the currency picture as well, what this all means for the renminbi. We're joined now by Stephanie Holtz, Chief Currency Strategist at DWS. So, Stephanie, first off, thanks so much for joining us this morning. Considering some of the growth concerns that Tom was just highlighting for us, you have Nomura and Goldman Sachs cutting their expectations for GDP in China. Should we see more weakness come from the Chinese yuan?
Right, Danny, I totally share all the concerns that Thomas just mentioned and that the market is digesting at the moment. And there should be some impact on the renminbi going down the line. Absolutely. There's especially three factors that worry me the most. It's really not just a tech crackdown in China. It's now taken a new dimension, and it's very difficult to see where this will stop, when this will stop, how this will stop. We're now going into really much more of a social component, and the spillover effects into global growth, given that we now have much higher growth concerns in China, an element. And whilst the PBOC will have definitely an interest to keep the renminbi as stable as possible, most probably there can be some downward trajectory for the renminbi that needs to be managed from their perspective. Absolutely.
So you mentioned the tech crackdown and this adding to the growth concerns. People who argue that this is a micro topic, this only affects China locally, there's no transmission mechanism for it to have a more global effect. What are they getting wrong?
Yeah, it's actually an angle that I do not share. I worry a little bit more. I don't see this as an isolated topic. On the tech crackdown especially, I would say we would have to be aware that this is not an isolated China topic. You know, just 2 days ago, the BIS, they have published a bulletin talking about how important it is, and it's called Regulating Big Techs and Finance, how important and with which urgency the central banks really need to act and limit the impact that big tech can take in financial services and monetary policy. So it's a topic that we will see absolutely spilling over too, and it will impact the global risk assessment as much as the growth concerns from China will impact global growth concerns too.
Right, so definitely a global story. Stephanie, you're going to stick with us. We have more to dig through. That's Stephanie Holtz-Jen from DWS. Now, coming up, no rush. The ECB's Martins Kazak says the central bank won't rush to signal the future of PEP. We'll discuss next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the ECB will not rush to signal the future of its pandemic program. That's the latest word from the Latvian Governing Council member Martins Kazaks. With nearly 600 billion euros left to spend and the program running at least through the end of March, he says it would be too early for a decision on whether to extend or phase out purchases. Stephanie Holtz-Jen from DWS is still with us. Stephanie, this divergence we're seeing between a more dovish ECB and a Fed, is that fully priced into the euro at the moment?
I'd say it's not fully priced in, but of course the divergence between the central banks of Europe and the US is also only one factor impacting euro dollar. But what is for sure, I think the ECB has made clear it's cemented its very dovish stance. What we are a bit more puzzled about and need to monitor very carefully, of course, is the US side of things. We just had Fed Governor Christopher Waller talking about maybe a couple of unemployment reports looking better, and then you can look at tapering earlier rather than later.
Right.
So these are obviously things that carry us this week as we get the ADP numbers today and non-farm payrolls on Friday.
Right, exactly.
This is something.
Stephanie, on that point, on the jobs numbers, so if we have data obviously today and tomorrow, could we see more volatility around the dollar if they are to gain in importance, if Waller is flagging these job numbers as something that potentially changes the taper timeline for him?
Absolutely. I say we are now getting much more used to data volatility and the non-farm payrolls numbers as much as inflation or the inflation components that we're getting today as well are now inducing a lot of volatility. This is something we need to be aware of. And given that euro dollar has been trading in quite a narrow range for quite a while, it'd be interesting whether we can test the resolve to either side.
Okay, and where is the bias currently? Is it a stronger greenback or a weaker one?
Well, to me, I see euro dollar on the very short term having the capability of bouncing back towards a 120 level. But on the medium and longer term horizon, I remain in the dollar bull camp on a variety of reasons. The policy divergence we already hinted on. I'd say the growth gap is obviously widening still towards the US. And thirdly, the US dollar is also still displaying its characteristics as a haven when it comes to bigger risk-off events. And we just discussed how the risk backdrop is changing at the moment and has changed also over the past, given the health outlook, etc.
Stephanie, if we can get some more into those risks, geopolitics seems to be at the fore again. You had the British Navy reporting a possible hijacking in the Gulf between the UAE and Iran. You had a deadly drone attack that the UK, US, and Israel blamed Iran for. Is this something that should drive more traders into haven currencies?
most probably it is driving some of the traders already in haven currencies. We have been seeing quite a move in the Swiss franc as well. So I would say not that these are only these geopolitical events that are the main drivers behind, but they play part and parcel in a changing health outlook, and also I think in a repricing of the reflation trade that has already started, and the FX world is seeing its part.
Right. And Stephanie, really quickly here, just 30 seconds, Delta variant spread, will that only fuel the drive towards havens?
I think so. It's also something that may not be as prominent as a topic in portfolio allocations right now, but I think it will become more so given we coming out of the summer holiday part where Delta will spread even more, and the impacts will only be seen in the future, not right now.
Right. Stephanie, great catching up with you this morning. That's our Stephanie Holtz-Jen, Chief Currency Strategist at DWS. Thanks again for joining us this morning. Now, coming up, we get more into the earnings season. Commerce Bank's second quarter earnings miss estimates. We'll dig into European bank earnings next. This is Bloomberg. Commerce Bank sticks to its revenue target despite earnings missing estimates. The lender's CFO tells us that they're making good progress on the restructuring plan. China sees its broadest COVID outbreak since the beginning of the pandemic. Analysts downgrade the GDP outlook for the world's second largest economy. And the ECB won't rush to signal the future of its bond buying program. A governing council member tells Bloomberg that investors may be in for a disappointment if they expect a heads up in September. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, where it's just heading up to 9:30 a.m. Now let's stick with that earnings story where Commerce Bank's revenue fell 18% from last year and net income slumped to a loss of 527 million euros. But the German lender reiterated a forecast for revenue to increase slightly this year as deep cost cuts and corporate restructuring takes effect. We spoke to Commerce Bank CFO earlier.
Well, first of all, we said that Q1 was exceptionally good from the revenue side. And if you now take the second quarter and you need to compare it to what we said, is basically that the net commission income is 7% up year on year. Very important and also very promising for the next months. NII, we said we would stabilize quarter by quarter, and we did. So overall, we think that we will definitely continue this trend in the next 6 months, and therefore we stick to our guidance that revenues this year will be slightly above last year's revenues, and nothing has changed on that.
Good morning, Bettina. It feels to me that Commerzbank has been doing new cost-cutting initiatives and talking about reducing headcount for so many years. It was a dominant theme when I worked at the bank almost a decade ago. I'm curious about, how bloated you think the bank still is. I understand it takes time for these headcount reductions, particularly in Germany, given the strength of the labour unions, and I know you've made progress on that this year. But is this going to be an ongoing theme for many years to come, or do you think we're nearly at the end of this cycle of job cuts?
Well, I mean, in times of digitization and ongoing technology, it's I think a difficult thing to judge because that is not only true for banking, but it's also true for other industries that you have always changes in the business model. And I think continuous improvement will be something which will be there all the time. But I mean, the big restructuring is now up, and we're making, as you said, very good progress. I mean, we announced the 10,000 FTE reduction until 2024. We are basically, we have concluded the general agreements with Workers' Council beginning of May already. We are now halfway through the detailed negotiations, so 50% is basically done. We have signed already with more than 3,000 employees a contract, and we have launched an voluntary program for people to leave until the end of this year, about 1,700 FTEs. And it looks good. So I'm pretty confident that at the end of the year, we will look on something where we have basically closed agreements with more than 5,000 FTE. So good progress on this side.
Bettina, you have a good sense, a good take on the German economy, and in particular the Mittelstand and those sort of mid-sized businesses. Do you think we've seen the peak in German corporate defaults? As you look at the recovery of the German economy, what are you seeing in your numbers? I see that you put out in your statement today, you say full-year loan loss provisions will come in lower than €1 billion. What are you seeing then in that provisioning?
Definitely improved the guidance based now also on the second quarter. And if you look on the second quarter, just for corporate clients, we even didn't see anything, to say it like that. We say still cautious. This is why we say less $1 billion. If you now look on the first half, we just booked 235 million. So we still have a lot of buffer for the rest of the year. Specifically, if you take into account that we have our extra buffer, the top level adjustment of 495 million, which we kept untouched. So we still stay cautious. I mean, Mittelstand is holding up very nicely. Also, our revenues on Mittelstand are 3% up year on year. We, however, still see that activity is not as high as we probably wish with respect to investment activities. And therefore, you see that also the Mittelstand stays pretty cautious. I mean, we now have the Delta variant, we have the Lambda variant, and hopefully we will come through the next months without further lockdowns, etc. And then I think we can be much more optimistic. In the moment, we still stay cautious, and this is why we kept the buffers as we have. But I think hopefully there will be quite some upside until the end of the year.
That was Commerzbank CFO Bettina Orlopp speaking to Bloomberg earlier. And as the worst of the pandemic is left behind, European banks do face a brighter outlook. Earnings results show banks paying back debt provisions and the cash taps are set to reopen to investors, with the ECB lifting a cap on dividends and buybacks come September. Let's get more into the European banking story. We're joined now by Magdalena Stoklosa, head of European Bank Research at Morgan Stanley. So Magdalena, we've basically made it through the bulk of European bank earnings. Has your outlook for the sector materially changed from where you saw it before the results started to roll in?
Good morning, Danny. Yes, I have to say that the earnings season so far, as you've mentioned, has been strong. And of course, you know, when I look at the banks, 85% of banks that reported so far effectively beat on a pre-tax level by an average of 30%. Of course, we can argue, you know, a lot of it is provisions, but even on the operating level, the banks effectively kind of beat the street by about 7%. So I do believe that after this quarter, the earnings forecasts are going to go up. If I look at our own forecasts, we've kind of gone up by about 5% for 2021 already for the banks that have reported on average. So yes, I think the earnings outlook continues improving, particularly for 2021.
Yeah. So one of the things I think, to your point, that really struck me was equity trading at a lot of these banks. For example, Deutsche Bank, SocGen, banks that had been kind of gravitating away from their trading desks, turning out really strong numbers. Does this at all change the calculation for these banks that weren't really looking to get any support from trading?
So I have to say that I believe that trading structurally actually has more support post the pandemic as well. Because when we kind of look at the big themes, we've got deepening of the kind of equity markets, deepening of kind of corporate debt markets as well in Europe. So I do believe that in general, we're going to see the trading income levels actually higher than what we have seen pre-crisis. You know, nothing like, of course, the excesses of 2020, but higher than what we've seen pre-crisis. So yes, I think in general, I do believe that equity business and to a degree also corporate debt business are facing quite a kind of nice structural future here.
Okay. And yeah, I mean, along the same lines, we saw fee generation come in really strong. Obviously, it's been a really busy period when it comes to deals. Do we know if the European banks have been able to take some market share back from the U.S., or is the pie just kind of growing bigger?
So interestingly, yes. I mean, these are kind of small market share moves, but we have actually seen European banks kind of claiming a little bit more of a market share actually in equities that we have just kind of talked about, so equity trading, and a little bit in banking as well. I think, those things move around a lot on a quarterly basis, but I think that the European banks are holding their own.
Okay. I also, Magdalena, I have to ask you, so overnight we learned that Lazard is the latest bank to be bumping up junior pay, $100,000, basically in line with a lot of the other banks. At this point, is it kind of just like you have to have a base salary for first-year bankers at that level in order to just be competitive, or can these banks really entice people into their specific firm with a higher level of pay?
So I have to say I treat this very much as an industry dynamics. I think we are, there's parts of the investment banking that are growing very, very strongly, and of course, banking is a part of it. And I do believe that a part of that growth is structural. We're going to see kind of more of it as we go into 22, 23, and I think that if a part of the market kind of raises the basic kind of rates, it's very difficult, to not to follow. So I do believe we're in a competitive space, and I do believe that given how many of the banks have raised over the last months, pretty much, I think that's a sign of just how competitive banking has become and how good of a pipeline there is.
Yeah. I mean, do we also have any read-through on kind of the hybrid working space? It feels like European banks, just for cultural reasons, have allowed more of that than their U.S. counterpoints. But is that continually the push that we're seeing a lot of the banks move towards? When I kind of look at various banks and various announcements over, let's just say, the last couple of months, I have to say I think they softened on both sides of Atlantic. To be fair, I think we have to be very mindful that the hybrid way of working is the future. It's just a question of where you're going to settle, and I think that's what we're going to kind of see in practice over the next 6 months, as, of course, other restrictions, more national restrictions, are lifted. Right. Magdalena, so great to catch up with you this morning. That's Magdalena Stoklosa, head of European Banks Research at Morgan Stanley. Thanks again for joining us this morning. I quickly want to give you some lines crossing on the UK economy. The UK services PMI coming in much stronger than the flash reading. The preliminary reading had been 57.8, coming in at 59.6. So that is certainly better than what we had been expecting. Of course, we had Freedom Day in the UK. The hope is that the economy starting to normalize here. Now, coming up, a short squeeze in the global bond market snares a big casualty. More on the $1.5 billion loss faced by hedge fund Alphadyne. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Let's get to your Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Dani. Bloomberg has learned the UK may block a takeover of chipmaker Arm by NVIDIA, citing potential risks to national security. NVIDIA is the biggest US chip company by market value. Last September, it announced a $40 billion deal to acquire Arm from Japan's SoftBank. A report by UK regulator, the CMA, is currently being considered by ministers. SoftBank is said to have quietly built a $5 billion stake in pharmaceutical giant Roche and is betting on its strategy of using data to develop drugs. A source tells us SoftBank sees Roche's data-based drug discovery and development arm as undervalued. Bloomberg data shows the Japanese conglomerate is now one of Roche's largest investors as it continues its investments in biotech and healthcare. That's the Bloomberg Business Flash. Danny.
Laura, thank you so much, Laura, right here in London. Now let's turn to the hedge fund world, where Alpha-Dyne Asset Management is one of the biggest casualties from a short squeeze in the global bond market. Sources tell Bloomberg that the investment firm is staring down losses of about $1.5 billion after its hedge fund bet on higher rates and a steeper U.S. yield curve. Let's get more from our Bloomberg hedge fund reporter, Nishant Kumar. So Nishant, talking about some of what caused them to see that $1.5 billion loss, how much do we know just about how wrong-footed their positioning was?
I mean, it's basically boils down to what happened in the bond market in the first half. First, macro investors had amazing trouble navigating the market twists and turns. The benchmark 10-year yield on U.S. Treasury, as we know, unexpectedly jumped 83 basis points in first quarter, only to reverse direction in the second quarter. And that caught a lot of hedge funds, especially macro hedge funds. Alpha-Dyne is one of the biggest losers, as we know, so far. In that epic turnaround or epic collapse in the market.
Yeah, I mean, Nishant, in terms of Alpha-Dyne itself, I mean, this is a fund that's not really known to lose money very frequently, are they?
We can safely call them the steadiest or one of the steadiest hedge funds in the world. Since they're starting in 2006, they have never had a down year. The most stunning statistics here is that the maximum this fund has lost ever in a month was 4.3%, and that was in June. It lost money on directional and relative value strategies in US, UK, European debt market. US stiffeners and short duration positions hurt it the most. And as we know, the yield curve from 5 to 30 years just flattened by more than 25 basis points in a span of 3 days. So if you are positioned incorrectly, and if you are caught by that, obviously you will suffer this kind of loss. But in Alpha-Dyne's context, this is something that is very unheard of, really.
Well, you did point out, Nishant, that this is something that a lot of macro hedge funds struggled with this year. What has that done to investor appetite in macro hedge funds more generally?
So macro hedge funds are at a very interesting phase. Just 6 months back, they had an amazing year. Some of the biggest names in the industry, such as Brevan Howard, Chris Rocco's, they had record year of profits. Caxton made 40% plus. And all of a sudden, we are seeing this reversal with macro hedge funds on the wrong side of the trade. And that has kind of shaken the confidence a little bit of investors. If we measure that by inflows into the industry, inflows have turned flat to small negative, primarily because investors just pulled roughly $6 billion in June. Right. So we will see, what happens to the returns. The environment it feels like this is a good environment for macro hedge funds to make money. But it all depends on the next few months.
Right. Well, Nishant, we'll certainly keep an eye on that with you. A fantastic scoop. That's our Bloomberg's Nishant Kumar. Thanks again. Now, coming up, the spread of the Delta variant means the new level of herd immunity could be higher than 80% of the population. We'll talk next with our Bloomberg Intelligence head of pharma, Sam Fazeli. This is Bloomberg.
Demand for transatlantic flying has significantly increased. So while the US is closed under the 2&2F to Europe and UK, US citizens can travel freely. I'm actually quite glad that the EU and the UK has opened up and hasn't demanded that the US reciprocate. I think that will take a little bit of time, but I do believe that we will get there. We expect business travel to recover, but to lag the recovery in leisure travel. I think there is some degree of acceptance now that business travel may not recover to the same levels as 2019, but I don't think it will be as impacted as some people believe as a result of technology.
That was IATA Director General Willie Walsh on the return to international travel. But the Delta variant could throw a spanner in the works. Its spread has pushed the threshold for herd immunity to possibly well over 80%. According to the Infectious Disease Society of America, the number could be as high as 90%. This is as China is seeing its worst outbreak since the beginning of the pandemic, and at least 46 cities have advised residents to refrain from traveling. Joining us now to discuss is Bloomberg senior pharmaceutical analyst Sam Fazeli. So, Sam, this study about possibly a higher level of herd immunity needed, do we have the hard numbers to back that up, or is this very anecdotal at this point that maybe it'll be 80% or 90% for herd immunity?
Yeah, hi, Danny. I don't think I've seen any hardcore publication of data or analysis. So, and honestly, calculating herd immunity levels, required herd immunity levels, etc., are pretty complicated and very difficult, and it will be dependent on the community, etc. So, but I completely understand why the Infectious Disease Society in the U.S. has said this, simply based on the characteristics of the Delta variant and compared to what we had before.
There does seem to be this sort of rethink of what we know about vaccines, herd immunity, given the Delta variant and how much it spread. Certainly anecdotally, Sam, I know a lot of people who've been fully vaccinated still tested positive, still got COVID, and presumably it's with the Delta variant. Researchers in England saying, okay, maybe you need another shot to target the Delta variant. How much do we know about that at this point?
Yeah, so the complication here, of course, isn't that anybody thought that vaccines were 100% effective against blocking all infection, which we knew they weren't. What they were aimed at was to try and reduce as much transmission as possible, and at the same time significantly reduce severe disease, which is exactly what's happened. So what we do know, though, is that the Delta variant is more capable of breaking through that initial shield that to infect you and taking a foothold, but still the vaccines protect you significantly from severe disease. So everything's working as expected. But if we continue to want to see a reduction in the number of infections, then we would need a booster. And I suppose once you're doing that, you might as well do it with the Delta variant booster.
Right. Sam, thanks so much, as always, for staying on top of this for us. That's our Sam Fazeli of Bloomberg Intelligence. Now let's get a quick check on your markets as we head into the end of the hour. We are continuing to see lower yields when it comes to German bonds and Japanese bonds as well. At one point, we had Japanese bonds below zero, the first time since December, but we are seeing the entirety of the German yield curve below zero. And so that certainly is pushing us towards the bond rally in the U.S. as well. Basically unchanged when it comes to your American equity futures, while European stocks up 0.5%, trading at all-time records as we continue through this earnings season. And the conversation continues with Bloomberg Surveillance Early Edition in the next hour. Matt Miller joins me out of New York alongside Kailey Leinz. That's next. This is Bloomberg.
There will be a broad, comprehensive approach to pandemic preparedness and response at every level.
The COVID crisis was, and to the extent that it is ongoing, is a matter of dealing with both the health and the intertwined economics here.
Experts tell us that we're going to see these cases rise in the weeks ahead, a largely preventable tragedy that will get worse before it gets better.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, August 4th. Our top stories today: risky business. The CDC extends a moratorium on evictions because of the pandemic, but President Biden warns the move may face legal challenges. High drama on the high seas. A possible ship hijacking near Iran ends when boarders leave the vessel. The question is, who was responsible? Squeeze play. Hedge fund Alphadyne loses $1.5 billion from a short squeeze in the global bond market. I'm Danny Berger in London with Matt Miller and Kailey Leinz alongside me in New York. Francine Lacqua is off this week. Kailey, certainly a more constructive handoff from Asian markets today. Here in Europe, it meant we could chart to all-time highs.
Yeah, a lot of green across the screen, at least in Asia and in Europe, Danny. In Asia, I would note one exception to that was the Nikkei in Japan. It did close in the red. One of the big drags within the index was SoftBank as well as Sony. But we saw stocks higher in China and Hong Kong, and the Hang Seng Tech Index up more than 2%. The People's Daily out of China seen as kind of a mouthpiece for the opinions of the Communist Party, still criticizing video games, but doing it with a softer tone than we saw in reports yesterday. So that gave a nice lift to the Hang Seng Tech Index, specifically Tencent, which did rise in the session after falling about 6% yesterday. It closed higher by about 2.4%. In other asset classes, I would point to the Japanese bond market because the 10-year GGB yield actually fell to zero for the first time since December. That is reflecting a lot of concern about the Delta variant and what it's going to mean for the economic recovery. And your big outperformer in foreign exchange, at least in the G10 space, is the Kiwi. The New Zealand dollar stronger against the U.S. dollar by about 0.7% after a strong jobs report, and that's leading traders to think a rate hike could be coming 2 weeks from now. As for what the picture looks like here in the U.S., honestly, not a lot of movement across asset classes. When it comes to the futures market, we're down, but not even 0.1% on S&P E-minis, only down about 3.5 points. And we're nowhere in the Treasury market. The U.S. 10-year yield still sitting at 1.18%. The dollar essentially flat. It was weaker earlier, now just a touch stronger on the day. Crude also flat. Still, though, just a touch lower, down for a third day. Matt, we're trading right around $70.52 a barrel.
All right, watching oil then not doing a lot. I should mention Volkswagen just came out saying that its finance arm is going to reach a profit 4 years earlier than expected because used car prices have gone up so much. So just touching base with Volkswagen right here in Wolfsburg, where I normally live near there. You can see that we have kind of a mixed picture here because the DAX is gaining 0.6%. The CAC is up, the FTSE is up, the FTSE MIB is up, but we're looking at losses here in Spain. So kind of a mixed picture in terms of what's going on in Europe. If you take a look at some of the individual movers, you'll see German stocks there as well. Notably, Commerzbank, it's the biggest loser, down 5% on the Stock 600, the broader European benchmark, because it missed on the top line, it missed on the bottom line, some expenses that were unexpected, and that hurts Germany's second largest bank. I also noticed just a few minutes ago a dollar spike, which resulted in a euro drop. We saw a Swissy drop as well. The pound coming down a little bit, but the euro, the biggest mover there, 118.51, and you can see German bunds barely changed, but still at negative 49 basis points, Danny. So there's a lot going on, but it's not all necessarily moving markets. There's deals with Apollo, CVC, and La Liga, a new SPAC from Betsy Cohen, a SPAC deal, I should say. So a lot going on in the world of M&A.
Yeah, there's just so much money around there, Matt, floating for a home. And I should say, to tie in that with your Commerzbank story, we are seeing more money flow to the junior bankers. Lazard, the latest bank to announce they're paying their junior bankers $100,000. I feel like now we should have a list of who's not paying their bankers more, Matt.
Yeah, definitely. And, it's all the same except for Goldman Sachs. They're paying more at 110, which I always love Matt Levine's column saying they're looking for mercenaries now if they're going to pay that much.
N.I. Levine on your terminal, always the place to go every day. Now let's take a look at what's ahead. At 8:15 a.m. New York time, we're going to get U.S. ADP unemployment change for the month of July. Then at 10 a.m., Fed Vice Chair Richard Clarida delivers a speech on U.S. monetary policy. That's going to be at a virtual event hosted by the Peterson Institute. We'll get the EIA crude oil inventory report, and that's at 10:30 a.m. We've seen a little bit of crude weakness over growth concerns. And then the earnings season bonanza continues on. We have General Motors and Uber among the companies releasing second quarter earnings today. Now, let's turn to geopolitics, where the British Navy said a ship was safe after a possible hijacking near Iran raised friction in the region. The incident comes days after the U.S., UK, and Israel blamed the Islamic Republic for a deadly drone attack on an Israeli-linked tanker. Let's get more on this with Bloomberg's Yusuf Gamal El-Din in Dubai. So, Yusuf, this incident, perhaps a false alarm, but how extensive have geopolitical tensions risen in the region?
Yeah, well, look, it might be a little bit too early to express any sigh of relief because, yes, sure, the UK Maritime Trade Operations, the agency that monitors these commercial shipping lanes, they've come out with a report and said the boarders have left the vessel. But that's all they said. We've tried to reach out to the ship that is a Panama-flagged boat to try and confirm any of these reports, but no confirmation so far. This happened roughly halfway between Iran and the United Arab Emirates. The Iranians have described their alleged involvement here as rumors and the fake news of Western and Zionist media. And it comes after that tanker attack that killed a Romanian and a Briton. Washington, we understand, is moving forces into the region to investigate that attack. That's according to the Financial Times. And when I try and look for repricing of risk, I look to the Saudi Arabian Riyal forwards on a 12-month basis. That is a bet against the local currency there. You know, that's risen on 10 basis points just this morning in terms of that spread. The background is a new Iranian president as well that's just taken office in the last 24 hours. And that brings with it a whole new set of considerations, guys.
Well, we also usually see geopolitical risk in the Middle East playing out in the oil market. What's the read-through there, Yusuf?
Yeah, just limited. Very, very limited. The reality is that these concerns and the anxiety around the impact of the Delta variant on a very nascent demand recovery, that's very real. And so what you're getting here, for example, on your Brent contract at just about 1/5% higher, the RBC guys are saying that the Iranian supreme leader may be betting that a policy of brinkmanship may yield more concessions. And you have 1 million barrels a day that are at stake from Iran. Remember, their gradual return to the energy markets was something that we've discussed for a very, very long time. Yep. And now that's no longer as clear-cut.
Got it. Yusuf, thanks so much. Bloomberg's Yusuf Gamal El-Din on the Iranian incident. Now, hedge fund Alphadyne Asset Management is one of the biggest casualties from a short squeeze in the global bond market. Sources tell Bloomberg the investment firm is staring down losses of about $1.5 billion after its funds plunged through July. Let's get more on this with Bloomberg's hedge fund reporter, Nishant Kumar. So, Nishant, what caused these losses? Just bad positioning?
Essentially, yes. So what happened in the first half is that the reflation trade that a lot of macro hedge funds were betting on, went bust, basically. So most of Alphadyne's losses came in the second quarter of this year, when fixed income instruments abruptly reversed direction. Declining yields along with flattening curves were really the most costly for Alphadyne. And right. it had a lot of exposure to those instruments, and it was slow to react to changing market conditions, and it lost, we estimate, according to sources, $1.5 billion.
Right, and Nishant, Alphadyne, not exactly a fund known to lose money, are they?
Not at all. They are one of the, or probably the steadiest macro hedge funds in the world. Just one statistics is enough to illustrate their steadiness. The maximum that they have lost in a month is 4.3%, and that happened in June. Since starting in 2006, they have never, ever lost money in a year. So it's quite odd for a firm like that.
All right, Nishant, thanks so much for joining us. Bloomberg's hedge fund reporter Nishant Kumar talking about one of the big stories in funds today. Now, the CDC has extended a ban here in the U.S. on evictions in 80% of counties across the country with high transmission of coronavirus. But President Biden warns that the new ban may face legal challenges and may be found to be unconstitutional.
Any call for a moratorium based on the Supreme Court recent decision is likely to face obstacles. I've indicated to the CDC I'd like them to look at other alternatives than the one that is in power in existence, which the court has declared they're not going to allow to continue.
Let's get to our Bloomberg Washington correspondent, Anne-Marie Hordern from the D.C. Bureau. So, Anne-Marie, he's basically saying this is likely to be found unconstitutional, but it's worth a try anyway.
It's exactly what he's saying, Matt. And what a U-turn we are seeing, given the fact that just 24 hours ago, we were talking about the fact that the White House, the CDC, did not have legal authority to do this, and they were punting it to Congress. Congress couldn't muster up the votes. So now the president saying he's talking to legal scholars, and many said it's worth a try. The one thing the administration does seem to be doing in terms of this strategy to try to avoid these evictions of potentially millions of people is to, at least by doing this alongside the CDC, and it's a new moratorium. It's to more targeted areas, 80% of counties where you see high spikes of the Delta variant. They're trying to buy time, Matt, to get that $47 billion of that relief that was allocated to state and local authorities to go to renters out the door. And through the legal challenges, at least they say could buy them some time.
Anne-Marie, the focus here in New York, where Matt and I are, is on Governor Andrew Cuomo and, of course, Attorney General Letitia James, finding that he broke state and federal laws by sexually harassing multiple women. He seems to have no one coming to his defense in the Democratic Party, including the White House and President Biden now calling for him to resign.
Not a single Democrat comes to mind that yesterday came out and stood with this once really highly regarded governor, especially when you look at where his poll ratings were last year during the height of the pandemic, 77%. Now he's below 50% on that. And the head of the Democratic Party, a.k.a. the President of the United States yesterday, calling for his resignation. Now, you remember Biden in March sitting down with George Stephanopoulos of ABC saying that if this report said that he did this, then he should resign. And Biden did not back down on that. Yesterday, you have a number of governors of border states with a joint statement yesterday, New Jersey, Rhode Island, all of Pennsylvania saying he should resign. Now it really comes down to, one, what are the next steps in terms of criminal and civil suits? And also there is already the New York State Assembly moving expeditiously, the Speaker of the Assembly says, in terms of an impeachment hearing on the governor.
Still an unfolding story. Anne-Marie Hordern, Bloomberg Washington correspondent, thank you so much. And later today on Balance of Power, don't miss a conversation with Senator Elizabeth Warren, the Democrat from Massachusetts. That's at 12 p.m. in New York, 5 p.m. in London. Back to the markets now. I want to take a quick check on some stocks moving in pre-market trading here in the U.S. And I have to begin with Robinhood. Of course, it just made its public debut last week. Didn't go so well. And then yesterday surged 24%, topping its IPO price for the first time on really heavy volume. And once again, it is the highest volume we're seeing in pre-market trading. Shares up another 7.5%. Another stock moving to the upside is Activision Blizzard. It, of course, is dealing with some controversy around its labor policies, but that being outshined by earnings that beat expectations and strong guidance for the video game maker. It's up 5.3%. And finally, also have to note Lyft moving to the upside. The big news is it made profit, an adjusted profit for the first time. This company has been losing money since it was founded, but finally gaining profitability in the second quarter thanks to a rebound in ride-hailing demand. That is up 1%, and we'll see if Uber can show the same thing with results after the bell today, Danny.
Setting the bar high. Will be interesting to see who wins the battle of the ride lifts. Kailey, thanks so much. Now, coming up next, we have Paul Donovan, UBS Global Chief Economist, and later we have Philippe Houchois, Jefferies U.S. and European Autos Analyst. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Danny Berger in London. Francine Lacqua is off this week. I saw this chart. Actually, Kailey and I both noticed this on the Taking Stock column. Danny may have seen it as well, for all I know. But it just shows that the forward blended EPS for the UK, and I'll welcome our listeners on London DAB as I do every day at this hour. The forward blended EPS for the UK has continued its recovery and now is back at levels, pre-pandemic levels last seen at the beginning of March in 2020. So it looks like, at least in terms of company earnings, earnings, the recovery is complete. The FTSE, however, which is the white line on this chart, is still trading at a 7% discount to where it was before the pandemic. So it looks like the economy, at least in terms of companies' earnings, has recovered, but the stock market isn't quite there yet. Joining us now is Paul Donovan, Global Chief Economist at UBS. And just want to get your take on where the economy is in the UK and why investors haven't ascribed the same value to stocks as we see in EPS.
Well, I think the story in the UK is that the substance is actually pretty good. The spin, however, is not quite so good. So the UK economy is faring pretty well. Restrictions are easing. The UK consumer is spending some of the savings that they were forced to accumulate in 2020. We didn't want to save money. We were forced to save this money, and there's obviously therefore a strong incentive to go out and spend it as soon as you can. So the economy is doing relatively well. We've always been an economy which has been able to work from home. About 45% of the population can work from home. We've got online retail sales, about 30% of total. So the UK is very adaptable as well. All good stuff. The problem is that some of the macroeconomic numbers, the way, for example, GDP is calculated here, different from everywhere else. And that gives a more depressing view of the reality.
So what does that mean for the BOE tomorrow, Paul?
Well, the bank, I think, is able to see through the data. It's run by an economist, which is always a good thing. And so I think that they are looking at an economy that is progressing nicely with the recovery. They've already tweaked the quantitative policy a bit. They've already slowed down the pace of bond purchases. And I think that they're going to continue to signal that, probably at the end of this program, that's it for the bond purchases, and we move to sort of an organic quantitative policy tightening.
Paul, let me move next door to the ECB. We had one of the Latvian policymakers today saying that the ECB won't rush to signal the end of the pandemic program. At this point, do we need to be assuming that there could just be forever QE?
Well, I mean, in a sense, central banks always buy bonds all the time. It's how they manage liquidity in markets. So it's there's always quantitative policy. All we're arguing about is the scale. So are we going to get large-scale quantitative policy? I think for the course of the next year, but probably not indefinitely. I mean, the central bank does have an inflation target, and that is something that is taken pretty seriously in the Eurozone. I mean, obviously, they keep missing the target, but they've got a new target to miss. And I think that with that, there will come a time when they are going to have to scale back liquidity supply, because liquidity demand will fade as Europe eventually gets into its stride with the economic bounce back.
Paul, I just want to continue this lap around the world and go quickly to China. We're starting to see downgrades to GDP forecasts because of the spread of the Delta variant there and the restrictions that are coming as a result. Do you expect a more pronounced deceleration because of that?
Well, China's facing really two issues, I think. We're already starting to see the effects of shifting consumer spending. So in the US and the UK, we're shifting to spending on having fun. And having fun is more service-focused than goods-focused. So if you look at some of the early data we've got on Asian exports from Korea, from Taiwan, the exports are fine, but they're slowing. Now, that's going to come to China too, of course, when we get their data. We're going to see perfectly decent export numbers, but it's less dependable as a driver of growth. So there was always going to be that slowdown. And then the Delta variant, of course, is affecting domestic demand, which is what people were looking to take over. China is rolling out vaccines more rapidly now. That is a positive signal. And remember, it's not actually the virus, but fear of the virus that does most of the damage.
Right.
But yes, I think that the more moderate views on Chinese growth are appropriate.
All right, we have to leave it there, but thank you so much for your insight today. That was Paul Donovan, Global Chief Economist at UBS. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Francine Lacqua is off this week. Now let's get the first word news. And researchers say that vaccines targeting the Delta variant may now be needed. The authors of a study looked at recent samples from 98,000 people in England. They found that vaccines' protection against development of COVID symptoms was down 59% from 83% earlier. That indicates the antibodies raised by current shots are less effective. Bloomberg has learned that the UK may block the $40 billion takeover of chipmaker ARM by NVIDIA. That's because of potential risks to national security. NVIDIA is the biggest U.S. chipmaker by market cap, and UK-based ARM owns the most widely used set of standards and designs in the chip industry. And Archegos Capital Management employees reportedly face losses of about $500 million after the value of a deferred play plan crashed. That's according to the Financial Times. Archegos, of course, was the family office that collapsed in March, costing several banks billions of dollars. Coming up next here on Surveillance Early Edition, we're going to talk about the global semiconductor shortage and the way it is affecting automakers. Philippe Houchois, Jefferies Global Autos Analyst, will be joining us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Matt Miller and Kailey Leinz in New York. Francine Lacqua is off this week. It is all about deals today. My head is spinning. There's so much money sloshing around out there. Matt, I think one of the most interesting ones, to me at least, is CVC buying a 10% stake in La Liga, the Spanish football league. This is a really hot place for private equity right now because, one, no ticket sales, and two, they just simply see a lot of money to be made in sports.
Yeah, absolutely. And we know that soccer is very big around the world outside the U.S. Totally boring to those of us here in New York, right, Kailey? But definitely an interesting deal for a piece of La Liga, which is one of the most important leagues. I also see a ton of other deals. Apollo picking up telecom assets for $6.1 billion. Betsy Cohen, who is the queen of SPACs, finding another deal in the financial services space, bringing her total to, I think, well over $12 billion in financial services SPACs. And then kind of the death of the NVIDIA ARM Holdings deal. The UK government saying there are too many security concerns to allow that to go ahead. Maybe not a surprise, but I think still very interesting considering that we had this special relationship, but it's not that special.
Yeah, we wanted a more global UK. Okay, that one might not be private equity. The private equity one's going ahead. The number for us, $59 billion. That's what KKR just fundraised this quarter, a record. Kailey, just so much money out there.
There's just a lot of money everywhere, it feels like, Danny. So much liquidity and so much cash and capital to deploy. Let's get a quick check on the markets, though, because in Europe, the picture's pretty positive. The Stoxx 600 at a fresh record high, up about 0.5%. Here in the U.S., though, futures are up. Or down, I should say, 4 points on S&P E-minis. Really not a lot of action in futures trading here in the U.S., so we'll see how things shake out come the opening bell in about 4 hours' time. Not a lot of action in the bond market either. We're essentially going nowhere on the U.S. 10-year Treasury yield, sitting right around 1.17%. And interestingly, the dollar was weaker earlier in the session, then saw a spike upward, and now the Bloomberg Dollar Spot Index unchanged on the day. Of course, we do continue to get earnings rolling out. We had a number of them coming out after the bell last night, some moving to the upside on the back of theirs. Invitae, a strong forecast for the year for revenue, up about 9% in early hours. Activision Blizzard also with a strong forecast and a beat in the second quarter, overshadowing some of the controversy around the company's labor policies and the fact that it's getting a new president, two new presidents, actually. That stock up 5.4% to the downside, though, after earnings. One of them is Alteryx, of course, a software company. It is expecting a loss both in the third quarter and for the full year. Analysts were looking for profit. That's taking the stock down about 7.8%, and Economy also down about 5.7% after their results, Matt.
All right, now, in terms of the car stories for today, automakers reporting earnings. The chip shortage continues to overshadow what could otherwise be a strong recovery. Here's what we've been hearing from the C-suite of the world's largest automakers.
Global semiconductor shortage has been impacting us.
It's been quite a whipsaw for us in the industry.
We're managing it week to week, day to day.
The chip shortage will continue probably throughout, I would say, maybe first semester of 2022. We'll have some, let's say, some fluctuation, some uncertainty and lack of visibility.
It is important to have the continuous monitoring the situation and how we can anticipate that for the coming the supply situation.
This is out of our control, essentially. It does seem like it's getting better, but it's hard to predict.
I think we have overcome chip shortages so far quite well, so we could manage, we could rearrange.
It's something that we're going to have to deal with through the rest of the year and potentially into 2022.
We have a lot of customers wanting to buy our cars, and we would like to build more and sell more. We don't see really that that's going to improve.
Really fascinating group of auto executives. They're the most powerful people in the industry. Joining us to discuss is Philippe Houchois, Global Autos Analyst at Jefferies Equity Research. And Philippe, to me, the most striking example thus far has been BMW beating the street's estimates yesterday by 25% with $5 billion in quarterly profit. And yet the stock was down more than 5%. What's the consensus as to when we recover from this chip shortage?
It's, I mean, you heard all the CEOs, they seem to be quite lost still about. There are two issues, I think, is one, there's some normalization of supply because clearly the auto industry has been squeezed out of the existing supply. There were some supply issues. But then if you look at projections of semiconductor content in cars over the next 10 years, as cars become more electric, more connected, potentially more autonomous as well, at least on an ADAS level, that structural need for chips continues to increase. So I think we have a mix of cyclical and structural issues there, which means we're still very much in the dark, as we can see some normalization of supply on a day-to-day basis, and most car makers and some were a bit more optimistic. Well, the longer-term picture of the structural shortage is still unclear.
When do we get back to equilibrium? I mean, if you look at the auto inventory to demand, it's unbelievable. There are no cars on the lots. Here in the U.S., I know people are slapping $10,000, $15,000 increases onto sticker prices. At what point do we get back to equilibrium? And then do we end up in a glut?
Mm-hmm. No, well, the question is, what is the next equilibrium? Because the U.S. certainly lived off a very high level of stock and kind of instant gratification. You find the car on the lot and you drive off with it. The question is, what is the next normal for inventory? What level would the car makers rebuild, and in agreement with the dealers, of course? Because I think no OEM wants to go back to the old normal in a way. And the question is, what is the next level? And can we move to a bit more build to order, simpler vehicles, and maintain that nice squeeze on pricing? The squeeze on pricing has gone too far in a way. And we saw the US data for last month, sales inventory, and the lack inventory is probably cutting into the SAR, as we saw in June. We saw it again in July. And but the question is, what is the next optimal level to rebuild to?
What do you think that level is, considering the pricing power that these car makers have been able to exercise? Is that not a lesson that it actually benefits them to produce less?
It is absolutely beneficial to them to produce less. Historically, we've seen average levels of 75 days of stock, much higher in light trucks, lower in cars. But it's very interesting because you look at over a number of years, Toyota, for example, has been carrying at least 20 days less stock than the Detroit 3. And they've been gaining share. In the past 3 months, they've been #1 market share ahead of GM. So I think it's also how you manage, how you sell. And the absolute level of stock is something that hopefully we're not going back to. And because we will get better pricing. We can also kind of price the option equipment better. So the number of benefits there. And we see that successful car makers like Toyota are able to operate with lesser level of inventory. That's the lesson for the others like Ford and GM and Stellantis.
If I could give you a very macro view of inventories, this comes courtesy of Jim Paulson over at Luthold Group that says that when inventories are low, this is usually the signal of early cycle markets, of a bull market that's going to continue further. Is that big picture? Is that the same with autos? The fact that inventories are so low, that chart that Matt showed us, does this mean that good times will soon start to roll, no pun intended, for the auto industry?
Yeah. Well, I mean, you could see two things. You could have a cyclical recovery. All of a sudden, availability eases and you rebuild inventories. The restocking is quite powerful for earnings and cash flow. So that's option A, less desirable possibly because we go back to the old ways of the auto industry functioning with too much inventory. Effectively, a gradual rebuild gives time for the industry to change its business model potentially. And that would be more interesting. But you're absolutely right. In the US, there's definitely a shortage of supply and demand has gone back to peak levels. Europe is a different situation because we have less inventory depletion than we see in the US. And so the market is still 20, 25% below the level of 2019. And what we saw in Europe is we never went back to the pre-GFC levels, even in 2019. And the question is, how do we recover the timing and the magnitude of the recovery in Europe compared to the US, where there's no doubt about it?
Is the transition to all electric going to go faster? Has the pandemic accelerated that transition?
I think the pandemic in many ways has been beneficial to the industry. And one, I think we also pictures of a cleaner world about 12 months ago or so in the first period of shutdowns. And I think the awareness of the need to move towards cleaner transport has reached out more potential customers in addition to the regulation. And but I think the two go hand in hand. When do we start to have an S-curve adoption? That's less clear. We also have to see an industry able to actually produce those EVs in large quantity. And that's not a given at this stage.
Yeah, exactly, and to charge them as well. Philippe, thanks very much for joining us. Philippe Houchois, Global Autos Analyst at Jefferies Equity Research. Now, later on Bloomberg Surveillance, we're going to speak with the CEO of General Motors, Mary Barra, joins us. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, an exclusive interview with Pioneer Natural Resources CEO Scott Sheffield. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York. Danny Berger in London. Francine Lacqua is off this week. Now, concerns about China's gaming and technology clampdown are easing this morning after state media tempered its language. Still, the question over the next steps for Chinese regulation remains, and the consequences of that. In a new column, Bloomberg News editor-in-chief emeritus Matt Winkler writes, the past 2 decades were widely assumed to usher in the transition from the American century to the Chinese century, but the world's money says not so. And Matt, it's great to have you on set with us this morning, especially since you hired me 21 years ago, and one of the first things you taught me as a young journalist was follow the money. That was your mantra. And now we're seeing that if you do that, the narrative we've grown up with these past 20 years seems to be not coming true.
Yeah, that's absolutely right. In fact, if you look at the past 2 decades, that's all we have in the 21st century, it's increasingly an all-American century. Not much has changed, actually, from the 20th century. And by that I mean, if you look at the world's most valuable companies, the top 10 by market capitalization, 7 of them are U.S. That's been the case, by the way, for quite a while. That predates, this recent clampdown that you just referenced. And what it's about is technology. It's about consumer discretionary companies. It's about climate change. And all of those areas are where U.S. companies are robust and growing fast. And you know what those companies are, because they lead the hit parade just about every day.
Does China want their companies to be the largest and most powerful, though, or would the Communist Party rather be able to exert control over them? What does that have to do with this?
Yeah, this is very peculiar because China's rise has been all about globalization. It's been all about engaging the West and doing the West one better, if you will. And so this recent restraint that we're seeing just seems odd in the context of what has made China so successful during the past 20 years.
Matt, there had been a lot of foreign money flowing into China. Of course, a lot of that had to do with passive funds, starting to include be it Chinese stocks or Chinese bonds. Does all of that money now, and the way foreigners approach the Chinese market, does that need to have a drastic change given what's happened in the past month?
Well, we're already seeing it, because if you look at the weighting of the world's most valuable companies, China is less than 10%. It's just not there, and its share is shrinking. And if you look at the most successful money managers, take Cathie Wood, for example, most recently, she's basically exited China for the time being. And that's a big event, actually, if you want to think about performance in the markets.
And she is. I mean, you reference in your column, she's done better than, I think, all other mutual fund and ETF managers over the past 3 years and 5 years. Climate change is a huge issue for her, and you mentioned that it's a big problem for China.
Well, yeah, you're talking about the world's #1 polluter measured by CO2 emissions. I mean, it's twice, for example, #2 U.S. That isn't going to change anytime soon. And so if climate change really is where people are focused, they're going to look at companies, and companies are going to look at other companies, for solutions. And the solutions right now are really coming not from China. They're coming from the U.S. mostly.
All right, Matt Winkler, Bloomberg Editor-in-Chief Emeritus, thank you so much. A great column out on the Bloomberg today. And don't forget, coming up later on Balance of Power, we will be speaking with a critic of big tech, Senator Elizabeth Warren of Massachusetts, of course, the Democratic senator from up there, at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Matt Miller and Kailey Leinz in New York. Francine Lacqua is off this week. Now, McDonald's is expecting its corporate workers to be in the office 3 days a week. This will provide them an extra flexible workday compared to before the pandemic. David Rubenstein spoke with the CEO of McDonald's in tonight's episode of Peer-to-Peer Conversations.
I certainly think one of the things that we saw was our ability to stay connected through technology. WebEx, Zoom, Amazon Chime. I've learned all the different teleconferencing tools, and they've all worked reasonably well for us. So I think we learned things there that we have the ability to stay connected. I think the other thing, though, that it highlighted for us is we ultimately are an in-person business. We're in person in the restaurants, or we're in person in the office. And so you lose something from culture, you lose something from a connectedness by being so remote. And so, while it worked well for the time, we're committed to getting back into our offices, getting back into the restaurants.
So will you be bringing back all your office employees back and say 5 days a week, just like before? Or are you going to say 3 days a week, or what are you going to do?
We always provided flexibility prior to the pandemic. So we had 1 day of what we called flex time prior to the pandemic, where people could work from home, or, if they needed to come in the office, we left it up to the employee. We're going to probably extend that. We are going to extend that to 2 days of flex time. But ultimately, it's about you've got to do what you need to do your job. And so the expectations aren't changing. But if you have the ability to maybe have a little more flexibility, but a minimum of 3 days, you need to be in the office or in the restaurant.
That, of course, was the CEO of McDonald's, and you can watch his full conversation with David Rubenstein on the David Rubenstein Show tonight, Peer-to-Peer Conversations. And now joining us is Tom Keene, co-anchor of Bloomberg Surveillance. He is joining us now. Tom, I know you also will be speaking with David Rubenstein a bit later on this morning.
Well, we will. We'll talk to David about McDonald's, about what we're seeing with the variant. There's the headline just out now, Indonesia saying deaths pass 100,000, the first in Southeast Asia. That's the global sense of the pandemic, and it begins to affect, Kailey, the yield market. You see it with price up and yield down. And the essential idea here is each nation's for themselves, but the sum total is a new leg up in the amount of debt with a negative yield. We're getting out to where we may breach what we saw a number of quarters ago. Kailey, it's really worth watching. I watched a Swiss 20-year piece, negative 0.196. John Farrell thinks I'm out of my mind. He watches a German paper. Matt Miller thinks I'm out of my mind. He watches a Japanese paper.
Only because you taught me to do that maybe 10 or 15 years ago, Tom, or at least, I like to see what's going on. With the yen, I also like to see what's going on with the UN. And to me, China remains front and center here. Even as they relax their language a little bit, you still want to know what's the next shoe to drop.
It is, and it's a different Pacific Rim. As we mentioned, the headline from Indonesia with the real difficulties there. I actually looked for James Byrne Murdoch, John Burns Murdoch, Matt, at the FT today in his wonderful graphical work. And the bottom line is this is about Latin America and Southeast Asia. And with that Indonesia headline, you see that global angst that gives you price up in fixed income.
Tom, we're about 50 or so hours, I think, to the U.S. jobs report on Friday. Do we just all wait and see and not do anything until that point?
Yeah, that's the right counsel. They'll make a three-ring circus out of it. We don't do that. We're going to go beneath the headline date at 8:30 on Friday. ADP today, claims tomorrow. But you're right, Kailey. You know what? You wait till you see those two large reports on Friday.
All right, right now the Bloomberg survey of economists is looking for 875,000 jobs on the non-farm payrolls number. Tom Keene, anchor of Bloomberg Surveillance, thank you so much. Now let's take a look at what else we're watching today. And Matt, we have more auto earnings coming up later this morning.
We do. I'm just looking. I just pulled up the Whisper number, and the Whisper is for 920,000 jobs, even though I realize that's slightly different than the survey. Maybe those Bloomberg participants who put together that number are a little bit closer. It's a very difficult number to predict. I'm looking forward to General Motors earnings. I'm looking forward to Mary Barra's interview coming up in just a couple of hours now. We're going to hear from the CEO out of Detroit, and we expect to hear, obviously, great margins. We expect to hear that they've done really well with pricing. The question is, what's the outlook, especially considering, the chip shortage? We've heard from so many automakers that they've done well in the reporting quarter. BMW, for example, as I said yesterday, and I said again today, it beat expectations by 25% on the bottom line, 5 billion euros in profit, but still the stock was down 5.6%. in Frankfurt yesterday because of concerns about chips.
Yeah, I'm going to keep it in the world of cars. I'm watching Uber earnings after the U.S. bell today, after the close. Kailey, you earlier in the show mentioned Lyft, really strong numbers, so the bar set high for Uber. They also dropped yesterday more than 4% on those concerns that New York City would require vaccinations for workers at restaurants, gyms, etc., and what that means for Uber. So I think analyst questions and executive commentary will also be really fascinating to watch, Kailey.
Yeah, Danny, what they saw in the second quarter in terms of the rebound in ride-hailing demand, it will be interesting to see if that picture starts to change going forward, given all of these Delta variant concerns. I also am watching the Department of the Treasury because they will do their quarterly refunding announcement today. This could be a big one, not because anything will change in terms of their recent refunding size, this time around $126 billion, but the department could signal a scaling back of its quarterly sales of notes and bonds. Basically, they just don't need to borrow as much going forward, especially out into 2022. So that could mean a lot less supply. JP Morgan, one of the banks that sees the Treasury making a move in November, and predicts that the net issuance of notes and bonds will be at about $1 trillion less next year versus 2021. So that is a big deal for the bond market. And especially, Matt, as we talk about the Fed tapering, if you're also getting a pullback in issuance at the same time, I wonder what the effect of that
really is. But they're not tapering yet, and that's the issue. So you could see prices continue to rise and yields continue to fall.
But both of those things could be happening come the fall. All right, that's something to watch today. But of course, there's also Bloomberg Surveillance that you can watch just ahead. Thanks so much for joining us. This is Bloomberg.